open a beer and listen to those beer-loving cash flow guys.
Hey, it's Mike and Blaine, and this is episode number 82. 82. Matter of fact, this is the second episode we have recorded this week, so we are on fire, man. We're all fired up about it. We're fired up about the banks. We're fired up about small businesses. We want to help small businesses, and I'm Mike Milan. That is my partner, Blaine Birch. What's up, man?
Man, I'm ready to go. 2 in 1 week, but you know it's been a crazy week, and it just feels like we got a lot to cover. We got a lot to talk about. Got a lot to argue about. So let's dive in.
Dude, I'm gonna tell you what. All right, so I'm doing the headphones like you said, and it's a tough transition for me. I'm gonna tell you because it's like I can hear an echo, and it's like in my ears, and it's normally not in my ears. So I've got a transition here to go through.
Mine's not echoing, man. So I don't know. Maybe it's those headphones because I just got the little like Apple ones here. I don't know. Anyway.
All right, so here's the thing. We're going to keep on this bank thing. You know, more specifically, we're going to orient towards small business.
Yeah.
I'm telling you, though, episode 81, if you guys are starting on 82 or you skipped 81, go back to 81 because there's probably 80 episodes of how courteous Blaine and I are to each other. This one had some heat, has some spice, man. I was really excited about it. What did you think?
Oh, I thought it was fun, but it's just because I don't care about the banks. Like I care about them too that we have to bank there, but I care about the small business. And you seem to really be backing the banks up, and I was not having much of that.
Man, no, see, you tried to put me on one side or the other. You're doing all this politics stuff to me, like when you can only be on one side or the other. I'm like, well, here's how I think it works. That's all.
No, I learned a lot. I'm sure everyone learned a lot, but today we are going to dig into business owners and the shit they have to go through and how do they move forward? How do they move forward right now? So before we do that, what are you drinking?
All right, so hey, tell you what, I'm wearing my Memphis Grizzlies hat. So Courtney actually found a beer for me. She goes, hey, you like amber ales? And it's called Moon Biscuits, amber ale, I guess. And it's called the Visual Dissonance Edition. So I'm going to assume the artwork, that's super cool, you know, anything from the moon, the stars, the atmosphere. More importantly, it's from Wiseacre in Memphis, Tennessee. So I'm all Memphis today. I'm all Memphis.
I do not remember where these guys are from, but I've had their beer. Indiana, I think. So today I picked up, now Toppling Goliath, I've had a lot of times. They are terrific. If you're looking for a great IPA, Toppling Goliath is amazing. But what I picked this time is, let me see if I can get it in the camera.
Fire, Skulls, and Money.
Fire, Skulls, and Money. And somehow this just felt so poetic and appropriate for today. Toppling Goliath, Fire Skulls, and Money, and it is delicious. It is a fantastic IPA, so I'm also excited about actually just drinking this one.
Dude, that's a perfect summary for what's happening, right? The fire, the skulls, the money, right? Fire, skulls, money. That's pretty good. But hey, by the way, I did get a gift card from a listener, a supporter, Larry Weinstein. I got it. I have not been to Total Wine & More yet, so I owe you a trip to Total Wine & More, and where I know they're going to have a great selection. So I'm excited. Probably next week, I'll be bringing some Larry Weinstein beers in.
Nice. That's awesome. Thank you so much, Larry, even though Mike's going to drink all of it. I still appreciate it. Appreciate it for Mike. Yeah, well, but if anyone's in a Scottsdale area and wants to buy me a beer, I will not turn you down.
So you keep saying that. Hey, and I'm telling you, did you see neighbor Pat,
yes,
came over last weekend in his Mike and Blaine shirt?
Nice.
Right? So he's got his shirt now. He came over in the shirt. It looks so good, right? Because he got the navy blue one with the logo on it. And I'm thinking, man, that looks so good. So neighbor Pat looks good. Thanks for sporting it, wearing it around the neighborhood. Make sure that you show everybody your Mike and Blaine spirit.
Awesome. That's awesome, man. Pat's been such a neighbor Pat. Got to add the neighbor part. Neighbor Pat has been such a massive booster for our show, so that we just appreciate it so much. And now I feel like I should have worn my shirt today. I'll wear it. I'll have to wear it next time.
There you go. All right. So the title of today's show is "What Happens to Small Businesses When Shit Hits the Fan." right? So, and that's basically what we're talking about is, hey, listen, there were a lot of people in the lurch. And I think we described it earlier last week as, the banks are at the center of a spider web, and just any little vibrations that they create can be felt all the way through, right?
Yeah.
Also, even 2 or 3 layers deep, that have no relationship with, we'll say, Silicon Bank or Signature Bank, but you could be paid by somebody that's there or owe people that are there, and they're in trouble. So, man, what's your think? You had a very strong opinion about small business owners and what should happen. So let's hear it.
Yeah, it feels kind of funny actually, because we're at episode 82, and literally, like, I'm CEO of Dry Run, where we help companies forecast their cash flow and their sales pipeline and figure out where the hell they're going. Mike is literally cash flow Mike, and this is the first episode where, like, we talk cash flow. It's weaved into all kinds of things through all these conversations. But this one, when you say shit hits the fan, it is literally. Cash flow is the foundation of that problem. That's what everyone is freaked out about. And so we're actually at episode 82, and we're going to be talking about cash flow. But that is, what kept people up at night. Like last weekend, I guarantee you, like, they announced it, what was it, Friday night or whatever. Mm-hmm. But it was late Sunday or mid-Sunday, I think, before at least I saw that they were going to at least cover the deposits. Think about how little sleep happened with the founders. First of all, the founders, Friday night, Saturday night, they probably didn't sleep till Sunday night. And a lot of the staff also probably didn't sleep. When you're talking pretty much half of the American startups, think about how many people were affected by that. And it was all cash flow. It was all, how are we going to carry on? We have to access that cash because we have to pay our staff. We have to pay our team. We have to buy inventory. We have to pay our suppliers. All of these things that mean the engine keeps going, we're suddenly at risk.
Yeah, so here's what I want to do. I want to kind of talk through the 3 layers, right? You got the banks, the customers of the banks, and then the customers of those customers of the banks, right? So there's kind of 3 layers that I want to go through. And it all starts with a cash flow problem. It doesn't matter which side of that you're on. There was a cash flow problem at the bank, right? And so that means anybody, if a bank can have a cash flow problem, that means anybody can. I mean, even the most successful companies, Dell's had it. The guy with the perfect push-up had it. So these folks were successful and running out of money. So don't think that just because you're small and maybe you're struggling right now that you're the only one going through it. Anybody at any given point in time can have a cash flow problem.
Oh yeah, I've heard over the years with talking with our customers at Dry Run, a very common phrase that has come back at us that they've said to us is it's just another zero. In other words, the businesses, some of them are bigger, and it's just another zero. And I remember talking with the CFO one time, and they were talking about the cash flow problems that they were getting because they were hundreds of millions of dollars a year in revenue. But the problem was there was a disconnect between basically finance and the massive sales team. And the sales team was getting into a habit of giving ridiculously long payment terms to try and bump up the size of the deal and to get the deal through. And they're kind of getting lazy and just saying, but this okay. We'll do this, but you don't have to pay us for 90 days. You don't have to pay us for 120 days. You don't have to pay us for 180 days. And it was causing a massive cash flow problem in this business that was pushing through a lot of money. And it was going all the way down to the operational level where it was causing problems. But the CFO is like, yeah, we had problems. They were a really quite a substantial business.
Yeah, well, and if I'm talking about the bank level now, how I organized my conversation today, the one that surprised me, the one that I didn't know about when we talked on Tuesday, was not Silicon Valley Bank, the one that everybody talks about. It's Signature Bank. And what I found out probably right after we talked was that Barney Frank is on the board. Here's what pisses me off. Barney Frank is a sponsor of the bill, the law called Dodd-Frank, the one that put all the banking regulations in place. If anybody should know what keeps a bank safe, it should be Barney Frank. How are you at the top of the food chain in a bank that's supposed to be following the regulations that you created, and that fails?
And that doesn't surprise me, because how often have you seen people in those types of positions of power and politicians a lot of times lead the way of do as I say, not as I do. Like, that's just, they have a separate set of rules where they feel immune to these things. They feel like, I don't know what they feel like. I've never been in that position, but screw them. That's what I'm going to say, to be honest.
Bank failures come down to a couple different things, and it's really one thing. It's management decisions, right? Mm-hmm. And the biggest thing that kills a bank sometimes is not following their own rules. They put their own rules in place and then make exceptions or make overrides or make changes to whatever the rule is, and that always causes some type of reverb all the way through.
Yeah.
But if we talk about their customers, and I'm surprised you never talked to Silicon Valley Bank at Dry Run, have you?
Yes, I have. Okay.
Well, I mean, you chose not to do business.
Chose not. Well, I got to say, it's not that I chose not to. It was like, we actually were considering them, and we thought, okay, yeah, maybe eventually we'll do that. But then because the bank that we're in, because we're Canadian based, so the bank that we're using in the U.S. has a direct connection to the one in Canada. But honestly, even then, they were recommending Silicon Valley Bank, and it just was easier. It was an easier, tighter connection for us to go with a different bank down there. Fortunately, but we also have the bulk of our cash is up in Canada, right? And I shouldn't even say it doesn't feel as volatile or as risky in Canada, but I don't know if I should say that, because what I'm betting on are the same things that you're talking about. Well, it's regulated, right? Okay, well, we've seen how people can get, like there's a point where, of course, you need some regulation, because otherwise people will go like free for all, and the risk will be through the roof. But if the regulations don't make sense, which honestly we've seen that more than enough times, if they're not followed, and then most importantly, it's some of these guys, I feel like they're like F1 teams. It's like they spend most of their time just trying to find the loopholes.
Yeah, I totally agree. And I've had two personal friends, right, that have actually had relationships and had current relationships with Silicon Valley Bank. I haven't talked to one of them. And I just briefly talked to the second one, and it was mostly on text exchange and things like that. But Patriot Software, are you familiar with them? I mean,
no.
They're big enough now to compete with, QuickBooks, Xero. They started off as kind of like HR software, and now they do accounting and those type of things. And they were banking customers, right, of Silicon Valley Bank. And the thing is, I mean, what I've seen is the people that were involved with the bank, there's been they either ignored it and didn't talk to their customers and kind of still trying to figure it out in the background, or they got out in front of it, right? And what we know over time is that if there's a problem, you have to get out in front of it. You have to start communicating early and often with your customers. Yep, we're aware of it. Here's what we're doing. Here's what you can expect. And I can tell you, I didn't realize this. On a group chat in Facebook, I saw somebody I don't know talk about how amazing Patriot's response was. So to me, I'm like going, that's a credit to leadership right there. Where there's a failure in leadership, when the banks failed, Patriot Software is going to come out with I hope, right, being as strong or stronger than they were when this thing happened. Mainly because of the way they responded, right? Because that word travels fast. Oh, they took care of us. Oh, they made sure everything happened. We took all these defensive measures. We didn't have to because Patriot was already 2 steps ahead of us. Yeah. It was like, wow. I mean, it's amazing to see that a company got out in front of it.
And you and I have talked about this a lot. Like the responding quick is so important when we're talking with customers. Anything that's an issue, responding quick is really important, like, and letting people know and having that transparency. But I think we talked about this the other day. One of the downfalls of Silicon Valley Bank, now there was, I think, a lot of stupidity, of course, and everything, but didn't it come down to they had shared something? You can refresh my memory, where they gave an indication that there was some potential issue there, and then it started to steamroll. And we've seen this before in all sorts of sectors, where social media can become an unstoppable train with zero depth. It's a single, like, it can be something really complicated that can turn into a tweet that can become what people believe is the 100% truth and become an absolute runaway, because there's no context, there's no anything behind it.
Yeah, I think that's super important. Silicon Valley Bank and Signature Bank both did something similar, which means they put a lot of their money, their deposits, in investments, which is normal. That's how banks make money, is to invest your money. But in Silicon Valley Bank, they did do two different things. Silicon Valley Bank invested in bonds, which is normally a pretty safe bet, right? Except for the fact that the bonds were so low interest rate, because everything was low interest.
And long term.
Very
long term, yeah.
And the thing is that when they experienced a cash flow crunch, now normally, like you and I in our businesses, well, I've got at least 3 levers sometimes that I can pull. I can reduce inventory, I can collect faster, I can pay slower. Well, the bank doesn't always have that option. So you got these tech companies that are struggling, and they start to burn down the money, right? So in order to keep up with demand of cash going out of the bank, they have to go sell some of their bonds. Here's the problem. The way bonds aren't like stocks, right? I mean, they kind of are, because they have to sell their low interest bonds. Well, when the Fed started to increase rates, the bond rates came up. Well, why would I buy a bond that only produces 1% interest when I can buy a bond that produces 7% interest? So there was no market. There was no market for them to get capital. After that, they had to go out to the market and raise money publicly. What I think they should have done was kept it internal and private, tried to raise funds privately, and increase capital internally. Mm-hmm. They didn't. They signaled to the rest of us, hey, we're going to do an offering. We're going to sell more stock. Well, that means that you're in trouble, right? If a bank has to go sell more stock and open more stock up to the public, that means they need money.
Yeah. No, okay, so maybe I'm naive. Okay. But how does it make sense because the idea with, and again, a bond isn't like a stock. An idea with a stock is buy low, sell high. Who thinks it's a good idea to buy really low, doesn't go up, and hang on for a really long time? Like, I don't understand the interest rates are low, so you're getting no money back on your investment. Why would you lock that in for 10 years? Like, to me, that just seems, it doesn't make any sense to me at all. Like, where is that going to go? The only way it can go with interest rates that low is up. That's where it's inevitably going to go.
I don't have an answer in the rationale. I'm surprised.
Do they have any?
I'm sure there is. I'm sure there's some methodology they use to be able to make that decision, but I can't tell you what it is.
But to me, this feels like supposedly the smartest people in the world making a kindergarten level mistake in their area. Like, I don't know enough about it. They should know. This is their area, right?
All right, and gosh dang it, you're gonna you're trying to make me defend the banks again.
Go for it, man. This is fun.
My only explanation is they were trying to balance out their whole risk, right? They needed more bonds because they were probably heavily invested in startups and other things that were high risk. They thought the bonds were low risk. What they didn't anticipate, and the bonds were low risk. You don't really lose money on bonds, except for the fact if you don't have enough cash and you have to sell them. Then you have to sell them at a loss, and they have these things called unrealized losses, right? And just you got more cash in, but not a lot. You lost a bunch of cash in the transaction.
Yeah.
So it's one of those things where I think they were trying to manage risk with these low risk bonds and all the other high risk stuff that they were doing. Is when the high risk companies had problems, they had to get more cash through the bonds.
Yeah.
And when they couldn't, because nobody would buy them, because at the same time, normally they could have just sold the bonds and got money. But when the interest rates came up, right, it was like 4 quarters or 5 quarters straight of interest rates rising. The bonds were worthless. Nobody wants to buy that type of bond.
So now, if banks have been invented in the last couple of years, maybe they didn't have history to learn from. Banks been around a hell of a long time, and interest rates have skyrocketed. What it's like every 20 years they're going up. It's this up and down, up and down, up and down. To me, it's and I know it's kind of the hindsight is 2020, except that's what these people were paid millions of dollars to know this stuff, to figure this out, to lower risk. And it just feels to me like it was like, nah, I know better than everybody else, so screw it. We're just going to do this because, like, they're just. It feels to me like it was as laughable as when these stocks skyrocket and you have people buying more to go, well, it's super high, so it's never going to end and it's going to go higher. That to me is completely risky, right?
Yeah. Yeah, like I said, I can't defend what it is. I tried to come up with an explanation, not a defense, an explanation to make it real for me, right? Like,
but okay, I still say that honestly, as a business owner, knowing what they did inside out even has no value. What I think we need to be talking about today is what are the effects on the businesses, on the business owners. And what do they do? What can they do to protect themselves?
Hey, before we do that, because I want to do that too, but I want to end on the Signature Bank thing, because we didn't talk about that. We talked a little bit about Barney Frank. But did you realize, and I know because you're a big, staunch supporter of it, 20% of their assets was crypto?
I've never said I'm a big, staunch supporter.
No, well, last episode, 81, we fought all about it. I'm like, hey, listen, there's a such thing as the law of diffusion of innovation, right? Which is sometimes we're innovators and we're early adopters of new technology, and sometimes we're laggards, right? We're going to wait till everybody else has it before we get it. Well, I'm kind of on that maybe early, late majority that I'll get in on crypto. So I'm not bought in yet. But you're on the front end. You're on the more front end. You're more early adopter on crypto.
I suppose, but I feel like I'm a late adopter from a lot of the people that bought way earlier than me. But to me, when I bought into crypto, and I've got probably a dozen different currencies or whatever you call them. When I bought in, it was because I started to really see what I believed was the application to it. And so am I super bullish on crypto? What I'm saying is, if you're a bank, you don't go buy a bunch of crypto right now because it is ridiculously volatile. I think crypto is going to be potentially a massive windfall within the next 5 to 10 years if you have a crypto portfolio now, because it feels to me very much like, again, like the dot bomb when people thought the internet was stupid, and streaming when it was stupid, and all these things that early on and the first little hiccup, people call it stupid. But then I look and say, yeah, but look at the potential applications, because that doesn't go away. The problems of moving money back and forth without paying the credit card companies a whole pile of money to do a really simple transaction, and being able to move money across international borders 1,000 times easier than the ridiculousness it is now. And then the fact that crypto has been volatile, but not to the level of some of the countries that are literally moving to crypto. I believe, actually, when I was at South by Southwest last week, they were talking about, they said North America's blind to it because it's volatile here. But if I remember right, they were talking about some of the countries in Africa and Argentina. Argentina was, I guess, because of their mass inflation, there's been a lot of uptake or a move to crypto because it suddenly has the stability of an international currency. So do I think crypto has, I think it has a massive future. And I think this, for myself, it's like, this is a good time to buy it. It's low because everybody thinks it's bullshit. That's when you make a huge pile of money. That is not something a bank should be doing. That's something that I do with disposable income. And if I lose it, I'm like, man, whatever, it's not going to make a difference to me. If it skyrockets, I'm like, well, I'm going to have got an extra $1 million to mess with, whatever it is. That's not what the bank should be doing. It's not funny money to them, right? That's people's money.
Yeah. But you can see how that's the same thing with the bonds. They were so low they couldn't get out of it. Probably the same thing with the crypto they were holding. Whatever value they bought the crypto at, we can all see the charts. What's happened over the last several years with crypto, it's fallen off the cliff.
Do you also think that's stupid though? Like that's what I'm saying.
Hey, dude, there's nobody in the world that thinks that a bank should hold 20%, in that asset class.
I'm not sure the bank should hold any crypto with what they're responsible for right now because it's highly volatile, right?
All right, so I'm going to disagree with that because you're wanting crypto to become mainstream. And the only way you can do that is to get the banking system to agree that it's worth it.
You don't know, but for me, the banks shouldn't be buying crypto until it's regulated. The split second it's regulated, then it makes sense because it's going to be a lot more stable. But I will also say that's why I own crypto now, and what I'm waiting for, and I think what a lot of people are waiting for. Crypto regulation of crypto is not a bad thing. That is an amazing thing because as soon as they're regulated, now institutional investors can dive right in and say, we can have 5% or 2% or whatever of our portfolio can be crypto assets, where right now it's like the Wild West. The Wild West is schmucks like me that if I lose some money, I'm like, yeah, whatever, I'm not going to. The bank holding crypto before it's regulated while it's completely the Wild West to me seems bonkers, but I'm not sure it's a whole lot more bonkers than going, let's get 10-year bonds on the lowest interest rate we possibly can and then lock our money in there. And if we have to take it out, we lose it or we get penalized. That to me is two ends of a stupid spectrum. And you keep circling back to the banks. I'm like, I don't care about the banks. I do not care about the banks. All I care about is they got to get their shit together. What I care about are the business owners because we're talking two banks. We're talking two banks. You know what was affected by it? I can't even remember the number. Was it something like 40,000 startups? Probably somewhere around 100,000 founders and millions of staff. And we're still talking about two banks led by idiots. And I have no problem saying that because it's like, look what they did.
All right, so I can't disagree with you there. I actually want to talk about the business owners. I just wanted to get that on the table because there's new information from 2 days ago that I didn't know. So I'm trying to say, okay, well, let's kind of circle back, wrap that up. Here's a bow. We're good with that. So what do you think?
So we're ready to talk about business owners.
Should we do? There you go. Hey, and before we begin, we might as well say we're going to talk about cash flow. So let's talk about Dry Run. Tell us about cash flow.
Oh, okay. I guess I'm the sponsor this week. So yeah, Dry Run. And honestly, if you guys are whether you're with Silicon Valley Bank or not, come and talk with us because I know there's a lot of instability out there. But what we do at Dry Run is we help you forecast your sales and your costs to figure out, first off, what we're talking about a lot today. What does your cash flow look like? What does it look? Can you make payroll Friday? What does it look like over the next 90 days? And all of the what if scenarios on, okay, there's a bunch of weirdness going on. What if this goes bad? What if this doesn't? But we also help you forecast your sales pipeline. And that's where we can help businesses, especially with highly, I'll say, lumpy cash flow and sales, where there's big highs, big lows in your cash flow and sales. We help you predict that, which means if you can see it far enough ahead, you can smooth it out and you can make a lot more money. And so you can come talk with us and we'll show you how to do that. We can get you set up on a trial. Just pop in a Dry Run, plug in your accounting software. We'll have you up and running in minutes, and you can figure out where you're at.
Yeah, it's good. And I'll tell you what I like about dry run is it gives me that visibility all the way out, right? I can do what if scenarios, I can make changes, I can do those type of things and see what the impact is. So dry run is especially if you have any type of complexity, in your money that's coming in or going out, or if he calls it lumpiness, and I'm going to add to it, I'm going to call clunky, which means it never feels like I have enough money to do what I need to do. That's clunky to me. You could be able to see that and avoid it, right? Because that's really what we're trying to do is keep businesses in business and, eliminate cash flow as a reason that businesses fail. I think that's our mission here, don't you?
Absolutely, absolutely. And honestly, if Silicon Valley Bank had ran everything through dry run before they bought that shit, maybe they would know. But let's go back to the businesses, because that's who we're here to help. We're here to help founders. We're here to help businesses.
All right. So to me, this goes back to you have to be prepared no matter what. This is just another one of those things, right? It doesn't have to be a bank failure. It could be a death in your family. It could be a tornado in your town. It could be a hurricane along the coast. It could be the pandemic like COVID. It doesn't matter. There is a business interruption. There's a thing that threatens your business and it threatens you, your longevity. So you have to make sure that you have enough cash to weather a storm, right? To ward off threats. And, I always tell people, 3 to 6 months operating expense, have that cash just in case. Now, the minimum, if you use the formula like days cash on hand, which is, I call it days to bankruptcy, because it assumes if you have no sales or low sales, how much money do I have to just operate the way I do right now?
Yeah, your runway.
If you're using that as a metric, 45 days or more, right? That's the minimum, which means that you can, if it takes the government or whoever, a month, 3 weeks, 6 weeks to figure something out, it doesn't kill your company. Yeah. These metrics, these, rule of thumbs help save your company. So, have you got some wisdom like that before we dig into something more specific?
Yeah, and I agree with you. I think you should have attempt the odd time I've had founders actually snicker when I say this, but you should have 3 months minimum in the bank to ward off, because most of our clients, virtually all of our clients are saying, this wasn't even a sound effect. Most of them are they're invoice-based customers. They invoice their customers large invoices for big deals or big sales, and then they sit there and await payment. And most are net 30 or whatever. 50% of those are going to be paid late. Average 45 days. That's how you live. Guaranteed, you're going to get paid late. And the safest way to look at it is, what if none of those invoices get paid? Do I still have enough money to get through the month and next month? And because things can get delayed, and they get delayed for weird stuff. And this is a great example. What if all your customers were tech businesses, and they all were banking at Silicon Valley Bank? And if this had gone weirdly sideways more than it did, maybe now you're not getting paid. Maybe you're not getting paid for 60 days, 90 days. And the most frustrating part, here's a stat that I know sounds it sounds fake until you think about it for a second, but 70% of the businesses that went out of business were profitable when they closed their doors. Profitable on paper. So that's exactly how is this we're owed hundreds of thousands of dollars. We can't get our money. And if you can't get paid, you're screwed. So having that nest egg is really critical. And it's not easy to build that up, but boy, it's important.
What's funny is I'm going to dig a little deeper on that 70%, which is of the businesses that file bankruptcy. Well, this isn't just close and go out of business and pay their stuff off. They actually have to file bankruptcy. 35% of those are profitable. Have easily profit on the books, right? And it never makes sense to you. Going, how did you make money but not pay your bills? And it's all about the lag. It's all about that difference. That financial gap is what I call it when I'm training. It's the difference in time between money coming in and money going out. It's the amount of time that you don't have enough money to run your business. And if you don't, that's what causes you to fail.
We earlier today, I recorded an episode of Turning Point, which is our dry run podcast. We had Kyle Friedman from Quickly on, and Quickly is it's a helloquickly.com. I'm giving them a plug because I know his businesses out there might need some help. They're a factoring company, and they make it really easy to just sign up and start sending your invoices from there. But for businesses that are in this, they're just waiting and that lag time is killing them, you basically are selling your invoice to them. And so they're taking a little bit off the top of the invoice, but you get your cash immediately. There is a massive benefit of having that cash immediately all the time. Just repeatedly, that cash is coming into your bank account today. Now you're going to have to build those other fees into your margins, because you can't suddenly have, it's not like, well, now my profit's cut down to nothing. So you have to build that in. But if you're able to build that into your pricing, man, there's a lot of companies that it should just be built into their business model, because that gives a lot of relief when it's we're not waiting. It's just that cash is in my hand, it's in my account, and I can do something with it.
Yeah, I've got to say though, that's got to be a temporary solution. And I know you plugged him in. He was on your thing. I just work with an accountant that has a client.
Yeah.
The fees for factoring for them for last year was over $600,000, and they have a cash flow problem. They wouldn't have a cash flow problem if they didn't factor.
No, I would say they likely do, but a completely different cash flow problem. And I don't know, I don't know what the fees are. You would have to go look. You'd have to see if the fees make sense. Can you build that margin in when you're pricing? I'm not too sure. But
I think factoring is just another lever. Like we said, hey, listen, I can collect a little faster. That's part of it. I can collect a little faster by taking some of the older invoices that I don't have time to chase down and give those up. But some of those fees are 20%. You're giving up 20% off the top.
I've never seen a factoring company with that kind of fees, those levels. But that's what you have to look at. You have to look at what the fees are. But because we've had factoring companies approach us before, I've never seen that numbers that high. That's you can't do it. You cannot do factoring on 20%. You don't have 20% margins in there. What I'm saying is they have to be some really tight fees, and you need to be able to basically build it in. But I also know, I was talking with, I told this story to Kyle. I met with the CFO before COVID. We just went for a drink and we were talking about it. And they have, now it was somebody he'd run into after, it wasn't a client. He'd run into him after the fact and was talking with him about his business. And we're from Alberta, and I don't remember what the company did, but I know it was oil field related. And these two guys had started a company. I can't remember if it was service or product, but they were, I think he said they were something around a $3 million company almost instantly. Highly profitable, massively profitable. And he said when he heard or talked with these guys or heard about the company, they had recently sold the company, and what he said was 10 cents on the dollar. They basically gave up their company because they couldn't get paid. The lag was just too long. And honestly, sometimes when you're dealing with the really big businesses, they will drag those payments out. And he literally said, he goes, if they had just heard the word factoring, they would be around today, because they were at a complete loss and literally just had to sell the company because they didn't see a way out. And I'm not first of all, I want to make it really clear. I'm not just going everyone go in and do factoring, but for some businesses, this is a bona fide way. But like you say, you got to know those. You got to know what are the fees. Doesn't make sense. Can you build some of that into your pricing? Are you still profitable? There's a billion questions that go there, but for some businesses, it can be an absolute lifeline.
Well, I mean, the product, the perfect push-up, which probably most people listening to this know it, right? Know that story. Now, they might not know the story, but they know the product. And he was a struggling entrepreneur down to his last $100 and some $1,000. He'd raised $1.2 million. And the product came out. It was actually a variation, a derivation, or derivation? Derivative?
Pretty sure that's a new word, but we'll try it. We'll use it.
I'll say a derivative. A derivative.
Texan for derivative.
Of the body rev. And you can go to YouTube and see what the body rev was, and you can see the handles inside the body rev that became the perfect push-up. Okay. And the thing about this is that when he built the perfect push-up, it sold $2 million the first year, and then he got on as seen on TV, and Costco picked it up, and Target, and Walmart, and everybody else picked this thing up, and he almost lost the company because the second year after everybody picked it up, it was $60 million in revenue, from 2 to 60. This is a success story that almost turns into a nightmare, because it is our dream to put our product in Walmart or anything like that. But the thing is, if you sell 100,000 units in Walmart, the next week they're going to order 200,000. Right? They're going to keep ordering to keep up with demand. Well, that means you got to fund everything up to that point. Yeah, the salaries, your rents, the raw materials, the manufacturing, the distribution, all that stuff has to get out to the Walmart stores. Yeah. Then they might sell it in a week. You don't get paid for 3 months or more. Yeah. So think about that you have to cover all the cost between you delivering the product to getting paid 3 or 4 months later. Yep. That's where that 3 to 6 months operating expense comes in handy, because it helps you close that financial gap. Yeah. Can you imagine, like I look at these businesses that have started like on the backs of craft breweries, which you can see how difficult that is to basically build your brewery, make your beer, all the way through to distribution. But it's all these little craft spirits places. And then you think about all the ones that are trying to do like barrel-aged spirits. It could be years before you can actually sell anything, right? Like, so depending on what market you're in, you could actually be in for a really long time before you can actually start bringing money in. You have to find a way. Yeah. Like you just have to find a way. And what he did over at Perfect Push-Up was he sold part of the company. He started selling equity in order to finance the operation. So that's another thing. I mean, do you really want to give up part of the company? Yeah. Just to stay, when you're successful, that's the worst time. That's probably the worst, decision you have to make is, oh my God, I'm so successful, I had to give it to somebody else. Yeah. Yeah. And that's the challenge is how do you deem success? And it still comes down to cash is king. Like, you can have, generally it's like, well, revenue. Yes. Terrific. Yeah. But you have to have profit in there, but if you don't cash flow, you're dead anyway. Like, it's just cash flow is what drives the world around. And, how can you move money through? And you know what? It's interesting because you hear this Perfect Push-Up guy. And if that was done today, that's a direct to consumer product. You look online now, how many of these companies are doing direct to consumer? They get a massive amount of buzz, a massive amount of momentum, direct to consumer. And the consumer's like paying with the credit card, which still drives me nuts because the credit card companies are taking way too much off the top, but you're getting your cash, not instantly, but that credit card company is just doling out that cash flow, right? There's other fees, like if you post on Amazon or whatever. I mean, not everybody's going to drive. You're not going to be able to just drive traffic to perfectpushup.com. You're going to have to use other avenues, I think. You may, but some of the real successes aren't. So, like Dollar Shave Club, I don't think they're on Amazon. They sold, though. Well, yeah. Like Gillette or something. Oh, yeah, because they probably came in and dumped cash on that guy. But the model, like, look at the model that they built, because they ramped up so fast. And they probably had capacity issues and inventory issues. But it was still direct. Like, you look at that, it was basically a SaaS model for product. It was directly to their website. There was no middleman. There's no apps. There's no distributor. And people are just coming and signing up for monthly. And it's like, here's a razor.
Like that's amazing to me. Like I know those aren't that's the superstar. Like this, it's not the usual thing, but it is a different model.
Well, what's funny is I still use their commercial as an example of the best marketing I'd ever seen, right?
Yeah.
And it was the dumbest thing. It's the CEO or whatever going through a factory, and there's weird stuff happening around him, like a gorilla on a skateboard. It's just the most ridiculous things happening in this commercial that gets you to go, what is this? This is great. It's great marketing. Great marketing. So.
Yeah, home run. Yeah.
All right, so let's think about it. I mean, we have factoring. You sell part of the company. You can use some of the leverage you got, collecting faster, paying slower, reducing your inventory levels. I reduced my expenses in 2008 in my hotel staffing and restaurants and all that just by attrition. As people would quit, I either wouldn't replace them or I'd replace them with part-timers. So even on service companies with labor, there's ways to control your expenses, which is really your cash flow on that side, to be able to keep up with it. Here's the rule, right? And I'll tell you the rule on managing expenses, expense control, because I think that's what you need right now if you're having less money coming in.
Yeah.
When gross profit is decreasing, so think of gross profit as the amount of money you have to spend. When it decreases, the amount of operating expenses has to decrease by the same amount. Operating expenses is the amount of money you spend. So if I have less money to spend, I should spend less money, right? That's as basic as you can get right now. And I think whenever there's a tragedy or an interruption in your business, you have to go back to the basics, right? When you have less money to spend, you spend less money. I have to decrease operating expenses by the same amount that gross profit decreases. Yeah.
That is often a lot harder than it is almost always a lot harder than it sounds. Like in dry run, I always have kind of a reduced spending scenario, and I have an emergency scenario. What do we have to do if we have to get it down? But there's some stuff you can't get rid of and still operate, because what happens is at some point, it's so easy to say, well, your gross profit's down, so we're going to cut some of the staff, we're going to cut this. But what goes along with that, it's a little bit like saying to a restaurant, well, if your food costs go up and everything, you just keep raising your prices. But at some point, people stop coming in, and then it's a trickle, and then a little more and a little more, and then you're out of business because you don't have people buying anymore. So it's a really delicate balance. It's not that easy. If you could literally just go, well, if it was that easy to chop 5% off the top or whatever, people would probably chop 5% off the top, but it's hard. That is a delicate balance. It's like a little ecosystem, right?
No, it's hard because you wait too late and the cut's too big. That's why it's hard. If you're actively doing this, right, actively trying to keep up with the gross profit, it gets easier because it's a little cut. It's the same way when raising prices. Every time I tried to raise prices big time, like I haven't raised prices in 3 years, I went from, maybe a 20% increase. Everybody complained. It was terrible. But like Starbucks raises prices all the time, 5 to 15 cents, and nobody says shit. They just pay it, right? They're like, oh, well, it is what it is. And right now, with inflation the way it is, I was in Texas Roadhouse last night, packed, still an hour wait on a Wednesday night.
Yeah.
How? I mean, if all food prices are up and inflation is going crazy, how are these businesses still having wait times in an hour?
It's going to be a really complicated question, right? But no, like that's what I say. Like all of these benchmarks that we talk about, like they make perfect sense. This is what you need to, but executing on that, it's a little bit like an idea versus execution. You need to know how to execute on that. And I know like that's what you talk about all the time is there's the getting down to the details on how you can do that. And that's what we're talking about dry run is all this stuff makes sense in theory. What we do is help you operationalize that and go, yeah, but how do you execute on that? How the hell do you figure that out? When there's dips, like, man, I was talking with an investor down in San Jose, or in Austin, and it was kind of funny. And I learned a lesson because I realized this guy never run a business. That's what I realized after. And I'm like, why was I even talking with him? Because he couldn't wrap his head around the idea that like a business owner has to make decisions. They have to negotiate. They have to do sales. There's things they have to do that AI can't do. You have to go and talk with a customer and actually land them as a customer. And it just occurred to me after, I'm like, if you've had to do it, you know it. If you haven't done it, it's all magic beans, right? But that's what this comes down to, is like all of these guidelines and numbers and everything. You have to do it. You have to have money in the bank. You have to have a beachhead there, or like a sort of that nest egg there. You know, these things that you need to do, but it's not easy. It's really can be hard, because most companies, there's a little bit of fat, but they're not generally spending a pile of money they don't really need to.
Well, one of my clients, this month, we found that even though he planned for a certain gross profits percentage, he wasn't getting it overall throughout the year. So we went back and just looked at each job. And what we determined that the more difficult jobs he was winning, right? He was winning more difficult jobs, but it was cutting into his labor because he was still bidding every job the same. But there's a level of difficulty that he wasn't accounting for.
Yeah.
So am I going, well, let's add a fee that when you know it's going to be more difficult, it's 3% more, right? So you're covering some of that loss that you usually have just taken, but when it's on an incline, or when it's a hole that's not 18 foot deep, you have to go 21 foot deep because of the way the land structure is. You know that when you're bidding the job. You can't bid every job the same in his world. There's a level of difficulty you got to account for.
There's two places where I see businesses kill themselves. Number one is underquoting, and they underquote because they're so worried about the competition, so they quote to perfection. Mm-hmm. They say, if everything goes completely right, we will do it in X amount of time with X amount of dollars. Yeah. And having been in business long enough and having an agency, like creative agency, for over a decade, that doesn't work. There's always shit that goes wrong. And that's part of the process. That's not like, oh, we made a mistake. That's part of the process. It's never works to 100%. And the second one is scope creep. And a lot of times the scope creep will come from the client, but if that's built into the contract and they have to pay for it, awesome. The worst part I've seen is when scope creep comes internally. And like, I struggled with that having a creative agency, because you have a bunch of creatives that go, man, it'd be really cool. I know this. What if we do this? So awesome, so cool, so good for the portfolio. And as soon as you're like in the creative industry and it's like you hear portfolio, and you're like, oh, yeah, that'd be cool, that'd be good, that's going to get us our next job. That's what you always think, right? No, it doesn't really work that way. That's the two places, and that is really those are the details. Like, that's where money is. Like one of our customers said, money is made and lost, and the success of a business is on business management. It's not on how good your product or service is. Uh-huh. That just has to be good enough. It's how you manage that, you price that, you deal with the scope.
Yeah. So, all right. So let me ask you this. We've spent 2 solid hours on this one situation, right? The bank's failing, how it impacted small businesses. What'd you learn?
Oh, man, you and I differ on the banks.
See, I was going to say, you don't like talking about the banks.
you have a better impression of these banks than I do. And you know what I don't know if it's what I learned, but what just reinforced is, as a founder, no one's there to really back you up and help you. You need to take the bull by the horns. You need to have your own safety net. You need to know exactly where you are, where you're going, how much money you have, how long do you have, and nothing's going to be perfect. So it's all up to you. Like, outside of everybody, your investors, your advisors, your banker, your accountant, you're like, frick, how many times have I talked with a business and like, oh, my accountant handles my finances? The stuff that's already happened.
Yeah.
You know what's on your plate? Where the hell you're going. The money in the bank and how long you have to run and your runway and everything, that's all on you. Ask them, go find out. Tell me, you guys reach out to me. Which accountant is telling you how long is your runway? What does your sales pipeline look like? That is on you as the founder. You need to be on top of that every single day and every single week, or you're going to fail.
Yeah, I can't agree more with that. And the thing I learned, that there was validation in, it doesn't matter what's going to happen. Again, it's this, or it's a natural disaster, or it's something personal that happens in your family. You have to be prepared for something that you didn't count on happening in your business. And you can only do that with cash reserves.
Absolutely. The only thing you count on is a surprise.
Yeah, exactly right. So, hey, this is episode 82. This is the second one in the week. You've been listening to Mike and Blaine. And if you have not seen our website, go check it out at mikeandblaine.com. We got cool swag now. Cool swag, and I have not bought my coffee mug yet, but I'm going to, man. What final parting words from Blaine?
Oh, man, like, check out this mug here. It's just like, it's
I need
so awesome. And if you guys are in the little Mike and Blaine on the back here, and I'm not even using it for coffee, I'm using it for pens. But go check us out at mikeandblaine.com. But most importantly, follow us, like us, whatever it is. Subscribe to us if you're on, whether you're on YouTube or you're on Spotify, Apple Podcasts, whatever you're on. Make sure you follow us because we're out here every single week. And also, if you have a topic that you want to talk about, get in touch with us. Either through our website, find us on LinkedIn, whatever. Come to me at dryrun.com. That's an easy one. Even chat. Say, I got an idea. Like, what I want you guys to talk about. We will talk about, we'll work. Well, I'm not going to guarantee, because if you have a dumb idea, we're going to say, no, it's a dumb idea. But we do want to hear from you. And because we are here to talk business for business owners. This is the real entrepreneurs and people that are in the trenches fighting it out every day. And that's why we did 2 episodes this week, because we know that you're out there fighting and battling every day, just like us. And you guys are the ones we care about. Amen.
So you've been listening to Mike and Blaine, and we're going to see you next week, episode 83.
Check out their website at mikeandblaine.com. Then subscribe to the podcast and buy these guys a beer.